You may be surprised by what I think about the CPI report. This seems to be a very important market event. This could determine the future of the market, right? I don't really view it that way. However the number comes is how the number comes, but what matters ultimately is not what the CPI number is. I actually think it's a bad thing for stocks and earnings if it comes in light. But the whole reason why the CPI is important, or inflation data is important, is because it gives us a guide to use to forecast what the Fed might end up doing. So that is why the CPI matters. If it comes in cooler than expected, the market is going to hope and potentially assume that the Fed will then do less in terms of constricting the economy, of which they want to keep interest rates quite high well into next year. So ultimately, the reason why I'm not caring so much about CPI is because I don't think it's outside of the realm of potential possibilities I see that it will come in such a way that it impacts the Fed. For no other reason than, do you know what the Fed's year-end forecast for CPI is? I don't believe you do, because the Fed doesn't forecast, at least my understanding, at least in their FOMC meeting projections, doesn't even forecast CPI or core CPI. They use core PCE. I might be wrong on that. It might be somewhere I didn't see, but based on what I've seen, they use core PCE and PCE and don't even look at CPI. So not only do I think even if it comes in light will impact the Fed's dot plot, for example, but I think no matter what happens, it doesn't even matter because they don't even look at it that much. Particularly CPI, they probably look at core CPI slightly more, but they prefer PCE. However, I do think peak inflation has occurred. I'm not sure that's necessarily the best thing for stocks, though. If you remember, in 2021, a big reason why stocks continued to rally is because they could do something called take price. They were experiencing margin expansion. They were experiencing earnings growth. Those are Goldilocks things for stocks. And at that time, when the government was giving us money, as far as the eye could see, the Federal Reserve was saying there's no reason to raise rates for several years because, inflation is going to be transitory. It did make sense for stocks to do what they did then. However, we're in a very different time now. Inflation turned out to not be transitory. And despite the strong GDP growth we saw in Q1, we didn't experience any earnings growth. We actually experienced earnings decline. That was only the beginning stages of the end of inflation. And the Fed is actively trying to restrict the economy. This is directly the opposite of what they did during the pandemic to cause inflation. And it's not so good for stocks. Right now, yeah, stocks are doing what they're doing. But, that's just the crazy part to me. That's the bubble, bubbles happen. They happen. But if you look at earnings, they're declining. Yes, Q1 was somewhat stronger than expected. And yes, the economy was stronger than expected. However, that was one quarter when interest rates fell. Interest rates fell. They peaked in Q4. They've fallen so far this year. However, they're now starting to make their move up. And, interest rates aren't a one-week phenomenon. These are a longer-term phenomenon. The Fed's trying to hold them higher for at least a year. Not even cut for at least a year still to this day, even though it's sometime next year. I believe it's well over a year still, or just about over a year, until they start to do that in the end of next year, potentially, if their generous assumptions of a decline in inflation come true. generous assumptions being their words, not mine, meaning they have visions of other possible assumptions that are not so generous. But they're going with their generous assumptions publicly and have trended to continue to raise those assumptions upwards in terms of the dot plot projections for future rate increases and inflation inflation forecasts. The market has simply been expecting inflation to come down in a way that it hasn't for a very long time. The Fed has stated its path. Everyone is so worked up about the CPI. And then you go back to what I said at the beginning of the video, the Fed doesn't even have a projection for CPI year end. And they talk about how they prefer core PCE. So why are we, preparing for a 1.5% plus move in the S&P 500 tomorrow? I don't know. But that is exactly why I'm not so caring about this event. I'm careful around it. I'm not trying to, short it right now, short the CPI read. I'm acknowledging it as an uncertain thing, and I'm going into it assuming that it's going to be cooler than expected and the market's going to rally. I'm good. That's as far about the extent of which I'm preparing for the CPI. I'm just granting the full-on ape case. That's what I'm doing. So I'm allowing the ape case to happen, and I'm also sharing with you my analysis. And this is what I'm coming up with. This is how I'm thinking about things with regards to the market and preparing for CPI. The leading economic indicators are all definitely weakening. Consumer credit is beginning to weaken. That means credit is contracting. Yes, the Fed may want to see that, although they've seen less of it than they would originally want. You hear that again. So I do expect them to continue to hike. But ultimately, they're trying to constrict the economy. So we saw an earnings decline with a higher rate of inflation in Q1 and a higher rate of economic growth. So I don't think it's such an outlandish statement to say if the Fed is trying to constrict the economy for several quarters, because even once they start cutting, it's not that they're trying to ease. It's that inflation has fallen, so as they're holding, the real rate of interest actually continues to go up. But towards the end of next year, they feel that they will be closer and have restricted the economy enough that it continues towards a sustained path to 2% inflation. And of 2% inflation, they can adjust, keep the real rate steady, prevent the real rate from continuing to increase and unemployment continuing to go up. And then they can just slowly adjust, and in 2025, they can start to get closer to the neutral rate, which we haven't seen since some 2017 or something like that, maybe 2018. So I think things are stretched. I think exuberance is high. I think Goldilocks is priced in. I think all that. Okay, but it's been a 6-month run of a lot of that, of fighting the Fed, of not adjusting as the Fed's expectations change, and over-adjusting, in my opinion, for earnings coming in, 1% better than expected in terms of a decline? Something like that, but still decline. But how does that offset with the higher interest rates? I don't know. But anyways, if that economic situation, if that continuation of the earnings decline continues, multiples near all-time highs, only exceeded during the dot-com bubble and the COVID bubble, I think that's quite extreme. So that's today's video, and until next time, peace out.